Hi, everyone, and good morning. We're back again with another episode of the Let's Talk Real. Hi, Kelly. How are you doing?
Great. How are you?
Very good too. Looks like you got some snow this morning, right?
Yes, we did. So my kids are like, "Is school delayed?" Well, Sophia was like, "Is school delayed?" I'm like, "No, your brother's already at school." So no.
She's like, "Can I stay home?" Right. No, that's funny. Kids always want to use the first opportunity they have to. Hey, that's
Yeah.
not. Let's skip school. Alrighty, so today we're going to be talking about conventional loans. So we're going to be explaining exactly what they are, what are their requirements, what are the characteristics of the conventional loans. And we're probably going to be starting with the myth of the day and explain to you guys something that a lot of people think about, which is that you need 20% down payment when you're using your conventional loan. When we first talk conventional, right, Kelly, everybody thinks you need 20% down, and that's not necessarily true. And we're going to break it down. But yeah, so we're going to be talking about the different types. So you need to know that you do not need 20%. That is definitely the biggest thing.
Correct.
Alrighty, so let's get started. Kelly's going to give us some insights on the characteristics of the conventional loan.
Okay. So good morning, everybody. Conventional loans are one of the most popular loans that people use to purchase a home. And hold on a second. So conventional loans are what we call our Fannie Freddie conventional. And Nini said the biggest myth of the day is 20% down requirement. And that is not the case. And we actually have a first-time home buyer where you only have to put 3% down. And again, we spoke about first-time home buyers in one of our other episodes. And one of the characteristics of that is if you haven't owned a home within the last 3 years, you're considered a first-time home buyer. So if that is the case, you only have to put 3% down. Now you do need your closing costs. Don't forget about that.
Well, let's not skip that part.
So with conventional loans, you only have to put 3% down. If you don't put 20% down, then you will be required to pay private mortgage insurance, which we'll get into a little later in this episode. But that is a necessity when not putting 20% down. If you put 20% down, then you don't have to pay that. That's a little less that your monthly mortgage payment is going to be.
Yeah.
So conventional loans are, like I said, they are the most common, and it's our Fannie Freddie carrier that does the conventional loans, and it's your basic mortgage where you put a percentage down, and that's what you use to purchase a home. Most realtors in this market that we're in, they're going to look for a conventional approval over an FHA and VA.
Yeah.
And
there's a reason for that. Maybe we can bring that up too. So in a conventional loan, when you are in a competing situation, I think we even probably brought that up in different episodes, but when you have a conventional loan, it's perceived to be a stronger offer, mainly because the requirements behind home conditions are a little less strict than, let's say, an FHA or VA loan. And that's why it is perceived to be a better loan. It is also mostly common used for like investors that are, if they are financing, they will be using a conventional loan because it is, again, not as strict. So when it goes through the appraisal process, there's probably going to be less requirements coming from that appraiser in comparison to an FHA or VA appraiser. So I think that's probably what do you mean there with the,
Yes.
the stronger offer?
Correct, because you look like a stronger borrower because conventional is more they're more strict on the requirements for you as the borrower, where they're not necessarily as strict on the property.
Yeah.
So that just kind of goes into the next piece with the eligibility. So the minimum FICO is 620, and that's actually across the board on all of the products at Sierra. There is no minimum income requirement. unless you're doing the 3% down first-time home buyer. It's we have two products. It's Home Ready and Home Possible, and that income limit depends on you, the borrower, where you're purchasing the property, and the property itself. So we actually don't know what that minimum requirement is until we run our automated underwriting system, which we can do. We would know within a half an hour of getting your application, getting in the system. So with those first-time home buyer, there is a minimum, but other than that, there is no minimum down payment. And like I mentioned earlier, the lowest down payment that you can put down on the property is 3%. And pretty much, as far as income and everything, we're going to pull everything like we normally do. We want to see 2-year history of employment and income. So it has to be consistent, as well as we need to see assets. We want to verify that you have enough money to put down, regardless of it being 3% or 20%.
Yeah.
And that's pretty much, for the most part, it on eligibility. Do you have anything to add to the eligibility on your side, just from looking at it from a realtor standpoint?
Not necessarily, no. It really comes down whether they can approve for conventional on my end, right? So once they are eligible to purchase that with that conventional loan, there is one thing that is crucial in my perspective, is the type of homes that they can go for as well. Because a lot of times, if a person has an FHA or VA, they might be more limited as for what properties I can show it to them. For example, condos is a big one. A lot of condos are not going to go FHA. They have to have some sort of certification of approval in order to be able to be purchased through an FHA loan. While with conventional, that's a little less strict. There's some limitations with condos when it comes to like percentage of renters and being approved by the Freddie Mae. But overall, you have way more property options, let's put it that way, when you have a conventional loan in comparison to an FHA loan.
And we can look up the condos. So make sure, whether it's an FHA or conventional, to make sure it's an approved condo. So there is a website that we can go on and look that up. So if you're going to look at a property, I can look that up to make sure that you're good to go to show it. So with conventional, a lot of your realtors are going to want to see conventional over the other types, because conventional means that they have a good borrower. Conventional is more strict on you as a borrower, whereas the others aren't quite. The government loans aren't quite as strict on you as a borrower.
That kind of falls in our pros and cons of a conventional loan there. So we already brought it up that it is perceived to be a stronger offer. So that would be a pro there, because it is more, like you said, more strict on the buyer approval side. So there's a lot more guidelines. So when a seller's agent receive a conventional offer, they know that buyer most likely had a more thorough approval process, and they're a stronger buyer overall. Not that an FHA buyer wouldn't be, it's just that there's different guidelines. And also when it comes to the inspection and appraisal process, conventional loans are more flexible, not as strict. So the sellers are looking for that because they know it will be maybe a smoother transaction process for the sale. So that's one of the pros on my side. Maybe you can give us some pros and cons on your end.
Yep. So you got it. So they're not strict on the property. That is definitely a pro. So if you have an investor and they're looking to flip, and there's a property that may not be in mint condition, if you go conventional, most likely the appraiser is not going to flag anything. There's the MI, the mortgage insurance on a conventional isn't quite as high, and you only have one mortgage insurance, whereas with FHA, for example, you have mortgage insurance, but you also have your mortgage insurance premium that you pay over the life of the loan. So with conventional, you don't have that. The other piece with conventional, and I have not received any of these, but most of my FHA loans aren't putting 20% down. But in some cases, if you put 20% down, you could possibly get an appraisal waiver, which is very huge in the competing market. I don't know the algorithm as to what
That was a surprise, right? Because sometimes you're like, for sure, this house is going to receive a waiver, and it doesn't.
Correct.
And then sometimes the other way around too. So
Correct. So I've had older houses, like older houses, not actually get the appraisal waiver, and newer houses not get it when the borrower was putting 20% down. But like the ones that we have received that appraisal waiver, that was huge in this market, because that's one less thing that has to be done. We could get the loan closed in 2 to 3 weeks, and it's done.
yeah. And we did mention that on our episode about how to make your offer more competitive, and
Yes.
that is a huge tool when trying to compete. Because if there's no appraisal, that's one last contingency that seller has to kind of worry about. So if a buyer comes in with an offer that has no appraisal contingency, no inspections, it's basically like a cash offer. They're guaranteed to close. There's nothing that can be stumbled in between, other than maybe the financing itself. For some reason, something drastically happened to the buyer, and they can no longer qualify for the financing. That would be the only last contingency that seller would have to worry about. But otherwise, it makes it super strong of an offer when there's no appraisal.
Yep. So that kind of goes over most of the pros for conventional. The cons, there's not many. Like we mentioned earlier, they're a little bit more strict on credit. So I'll just use an example. If you had maybe a Chapter 7 and it's dropped off, it's been more than the 7 years and it's dropped off, and you have somebody else who never had a Chapter 7, most likely that other person who had the Chapter 7, we may or may not get an approval, whereas your interest rate will probably be a little higher. You may have to pay a little more just because of the credit history versus somebody who had a little bit better credit. And the other piece that you might have to pay a little bit higher on is the mortgage insurance premium. So I always tell people, the better the credit, the less you'll pay in mortgage insurance.
Yeah.
Again, I don't know the algorithm. I just know that if your credit isn't up to par, but you're still able to go conventional, we can still get an approval conventional. That mortgage insurance is going to be a little higher than somebody else who has a little bit better credit.
Because there's more liability on the bank's end.
It is.
To lend money to a person.
It's a more risk to us, and again, that's just part of mortgage insurance. So those are mainly the bigger cons with conventional. There's not many. They're just tough on you.
There's a chance that the interest rate could be potentially higher, also because of credit, correct?
It could, but it couldn't. It depends. Again, if your credit's not up to par, but you're putting, 20% down, you may get the same interest rate as somebody who's only putting 5 or 10% down, and but yes, it could possibly affect your credit score as well, not having up to par credit. I have seen it differ, not by a whole lot, but you may get a little bit worse, a little bit less, a little bit higher interest rate. I was going to say lower interest rate, a little bit higher interest rate with.
And you mentioned that 20% is not required, but what are the other options? You said that first-time home buyers can be 3%, but there's different variations in well, right?
So yes. So I was going to go into the private mortgage insurance next, which kind of I wanted to talk about the 3% down.
Okay. So let's get into that, and then we mention.
So with the different variations with conventional and putting the money down. So we have our Home Possible, Home Ready, 3% down. Now the mortgage insurance for those two particular products is going to be higher. If your credit score is good, you're still going to pay a little bit higher rate to get mortgage insurance, just because it's higher risk to us. You're only putting 3% down. Obviously, the more you put down, the less mortgage insurance you pay, but it's still there. And again, private mortgage insurance is something that is paid to help secure the lender. If you, the borrower, were to go in default, that protects us. So that's why there's that 20% mark. If you're putting 20% down, you don't have to pay it because you're a strong borrower. We know that you have the money, you put the money down, you paid your closing costs, versus somebody who's only putting 3% down. That's why your mortgage insurance is much higher on a 3% down versus a 5, 10, or 15% down. But do you have anything to add to that?
On the PMI?
Yeah.
No, I just actually thought of one additional possible con on conventional that I didn't think about it before.
Okay.
So just not to kind of jump around, but to just remind some people. So when it comes to negotiating seller's assistance, if you are using a conventional loan and you're putting less than 10% down as a down payment, you limit yourself with the ability to negotiate seller's assistance of up to 2%. In Pennsylvania, we are allowed to negotiate up to 6% overall, but when you're using a conventional loan and you're putting less than 10% down, then your max allowed for seller's assistance is 3%, which is not necessarily a con, but I guess that's a limitation. So it is sort of a con. So we are maxed at 3%, but once you put more than 10%, then you can actually get up to 6%. Is that correct?
Yes, that is correct. And sometimes the other piece, which would be kind of like maybe a pro and a con, but you can kind of work that seller assist with how much. So say you have somebody who's not putting as much down and maybe they need seller assist, but they're a strong borrower. I'm kind of losing what I'm saying here.
Were you going to talk about the buy down, or?
Well, yeah, you could put that into the buy down option that we went over. That would be that. So yes, if you added the buy down in with that particular scenario, that's more of a competitive offer for the seller. That even though they're putting that percentage down, maybe they want to do the buy down with the lower interest rate and get seller assist. If they're putting a little bit more down and they want that lower interest rate, they could get up to 6% if they put more than 10% down.
I see what you're saying. So if they get
that makes sense,
more money down and then not add. Yeah, that makes sense.
And then the seller assist could be put towards the buy down for the borrower to get that lower interest rate, given it's a good borrower. Obviously, if they're looking to put more than 10% down, then you're more than likely going to have you're in a little bit better buying position if you're putting more down.
Yeah.
So yeah, but
it's a good point.
So back to the seller assist. You are absolutely right. If you put more than 10% down, you can get up to 6%, and then anything less than that is 3%. So I don't know if you consider that a con or not. It
is sort of a limitation. So I would say maybe a con on conventional, but you're still able to get assistance. It's just that it would be more down. And it's, to be honest, today's market is very tough to get a 6% seller's assistance. But if you get 3, that's already amazing. So in a conventional loan, it's actually not bad that you're still able to negotiate up to 3. And sometimes we actually negotiate flat amounts just to kind of help that client be within the max limit of cash out of pocket that they have. So we try to work it out in a way that is not as asking too much of the seller, but at the same time still helping the buyer just as much as they need in order to make that deal happen.
So, and the only other thing I want to say about PMI is if you are not putting 20% down, your private mortgage insurance will drop off when your balance is at 78% loan to value.
Yes,
if you
that would be an automatic drop off, right?
That's automatic. So if you know what the 80% number is, which I can give anybody because it would be 80% of the appraised value or the purchase price, which the lower of the two when you purchase a home. I can give you what that number is. When your balance gets to that 80%, you can call and have it removed.
Yeah.
If you don't do that, then it does get removed at 78%, but you can call once the balance gets to 80% and have them remove it at that time.
Yeah.
So, or
So just to make what?
or you can have another appraisal done on your property.
I was going to say that. Yeah. Yeah.
Most people, once you get to that point, they don't. But again, everybody's situation is different. So
Yeah.
and
You never
everybody
know.
has a different take on it.
So my thing on that. So just to give maybe even further insight onto it for them to understand. So if we think of a purchase price of $100,000 to make it super simple, right? You bought the house at 100 and you were approved for a conventional loan where you first time home buyer, so only 3% down. That means your financed amount, even though you bought it at 100, you put 3% down, so you put 3,000 down, and then your financed amount is 97. So you know that PMI is going to drop off automatically when you hit 78%, which would be when you pay down from 97 to 78,000. So that's basically what we mean with the percentages there. The reason why it's so important for you to stay in touch with your realtor is that if the market, like for the last 2 years, a lot of people took advantage of that, because if the market is going up very quickly, your expectation of getting to that 80% might be maybe 5 years, but depending how quickly the market is going up, you might reach that 80% much sooner. And it might make sense to get an appraisal to drop off the PMI much sooner as well. And also staying in touch with Cali, because again, interest rates could be dropping. It could make sense financially to refinance at that point as well. And then you might be able to refinance and remove the PMI at that point if you have enough equity. So there's different ways to go about it, but staying in touch with your realtor and your loan officer is really key after you purchase as well. So don't think like you only need us before, because afterwards it's actually pretty important too. That way we can keep an eye for those numbers for you and potentially save you money on the long run of your loan as well.
Yes, because more than likely, if you were to refinance, we would have a new appraisal done, and more than likely your home has increased in value. Most homes do. Some homes appraise higher than others, but the average home does increase in value over time.
Yeah.
So and again, it definitely makes sense to keep in touch with both of us, just to see, like with Nini, where's the market at, like where are the home values at, versus, and then me to see, does it make sense to refinance? Because I can run the numbers, and if it doesn't make sense, then I would say don't do it. But if it does, then yeah, do it. Because I can do scenarios where it shows you how much you could save over the life of the loan if you were to refinance. And sometimes you save, sometimes you don't. If you don't save, then obviously you don't refinance. But if you are saving, then it definitely makes sense.
Yeah.
So
that's probably the biggest takeaway of the day. Stay in touch with us.
Yes.
To make sure we can help you on the long run. But maybe we can do a little quick summary then of the convention. So we mentioned about the big myth of conventional loans having to have a 20% down payment. That's not true. There's many different types of conventional loans out there. The first one was the first-time home buyer with 3% down. And what did you just say the name of the program was, Melanie?
There's two, Home Possible and Home Ready. One's Fannie and one's Freddie. that rhymed.
Yeah, so that's like the biggest part there. And then some characteristics. See, that's the Brazilian in me. We cannot say the words. But it can be that you could potentially have a stronger offer with the conventional loan because it's perceived to be a better type of loan because it has less restrictions when it comes to property condition and property type. It allows you as the buyer to look at a bigger pool of houses in comparison to other government-backed loans. And then the eligibility requirements, you can summarize that for us.
Yes. So eligibility, minimum credit score is 620. There is a minimum income requirement for the Home Ready and the Home Possible, the 2-3% first time home buyer. But other than those two products, there is no minimum income requirement for conventional. And your down payment, the minimum is 3%. You don't have to put 20% down for conventional, and we want to see a 2-year history of income and employment. So we want to see that it's consistent within the last 2 years, and we would want to, as far as your assets, we would just look at your most recent months of what's in there in the bank. So we just want 1 month. We don't need to see a 2-year history of your bank statements. Just 1 month is usually what we look for. And that's pretty much.
And the higher your credit, the lower your PMI is.
Yep, the higher credit, the lower your PMI is, and the lower your interest rate as well in certain situations. But
if you're preparing to purchase, that would be the biggest thing you can do on your own is work on your credit. Because it brings you so many advantages. So if you don't remember anything we talked about today, remember that. Just work on your credit, and then reach out to Kelly when you are in a good position.
And credit, the biggest thing with credit is the biggest thing with keeping a good credit score, increasing your credit score, is using your credit, but paying it on time. So if you have credit cards that have annual fees, you want to pay those off and close them out, because there's no reason why anybody should have an annual fee on their credit card. So using your credit, making your payments on time, and getting rid of any credit cards with annual fees, those are some important tips to keep in mind, especially with the spring market coming up, and just taking a look at your overall scenario with what you have with your credit, and that'll only help you.
And make sure if you have multiple credit cards that you actually do use all of them. Just like, even if you put $10 into it and pay it off, that is actually great. But I always make sure you never use more, or you pass it over to the next month more than 30% of what you have as credit. So I always keep it under 30, right, Kelly? I think that's
30% is the number. If you're looking to pay them down, because sometimes when you pay things off, it could possibly hurt your score. But if you're looking to pay things down, if you pay it down to the 30% mark, that's a good number to stand by.
And then just keep revolving that use of those credit cards. Even if you don't use it, just make sure you put yes one time in there, just so you have something, and then pay it off. Because they keep an eye on your usage as well. And it might potentially help you boost up the credit limits for those cards too. And then if that happens, your credit becomes higher than your debt. So the debt to income ratio, it's huge as well when you're going for approval with a mortgage. So keep that in mind. If you're not doing that right now, start doing that now.
We didn't talk about the debt to income ratio.
We didn't.
28 and 32 are the key numbers, but we can go up to as high as,
is that 42?
Well, yes, 42 on conventional, but sometimes you can go a little higher with the first time home buyer, but 28 and 32 are the numbers you want to try and stay at.
And it's hard for a person to know if they are on those percentages, right? So that's why it's so important to at least talk to them. If you're not ready to get approved now, but you want to have an idea of where you are, at least you can have a conversation with her and understand that. That way you guys can work together and get to the point you need to be. A lot of people, they decide, I want to buy a house now, but we don't do preparation. If you are even thinking, a lot of people tell me, I'm just looking. Well, that's the time to start looking into your credit too, and start talking to the loan officer, because when you are ready to buy, you need to be ready. And a lot of people want to get ready and do everything at one time, and that's not necessarily how it should go.
Right.
So this kind of work happens months before. It happens on the phase of just looking. that people always tell me. So when you're just looking, you start looking into your finances, talk to a loan officer, and understand where you need to get in order to be the best and most qualified. So you can get the better terms of your loan, the better interest rates, the better PMI. And a lot of people just don't think about that because they don't know, right? They don't know any better. And that's why we're here.
Yep. And I wanted to quick say, so people understand what 28 and 32 is.
Oh, yes.
So 28 is all of your current debt versus your monthly income.
Yeah.
And then the 32% is all your current debt plus the new mortgage versus your income. Just so people understand what 28 means and what 32 means. So that's what those two numbers are.
And you said we can stretch it out to the 42, sometimes even a little past that for first-time home buyers.
Yes, you can. There is some wiggle room in there for people, but 28 and 32 are the numbers to stand by.
There it goes. Well, do you have anything else to add for this episode today, Kelly?
I don't. I think that pretty much covers our conventional loans.
Okay. I don't think I got any questions today from our live watchers. So if you're watching this after we went live, make sure you can DM us on whatever platform you're watching this from. Send us a message or call us in the number below. We'd be happy to further explain anything that was talked about today or in previous episodes. Alrighty. Okay, Kelly, thank you so much for joining me today again.
Yep.
And thank you all that was watching and is still watching because I see we have some people live. So thank you so much for joining us today. And we look forward to seeing you guys next week on our Let's Talk Real.
All right.
Goodbye.
See you later.
Yeah.